Yes, very, very good afternoon. Hardik, Lahari, Nitin, Niru, Abhishek, Dinesh, Manvi, Vinuta, Anjali, Pranav, Pallavi, Nitish, Aniruddha, Sai, Ragini, Tambeshwari, Shibu, and Preeti. Jai Surya, Anuradha, Nitin, Karan. Yes, very, very good afternoon to all. I hope you all have been doing very well and also studying well, right? How are your studies going, students? Going good? Great. So, so students, we are now in the last leg of our syllabus. Now you have studied the four heads. You have come to know how to compute income. Now, the income tax law provides for different types of benefits, relaxations. One in the form of exemption, which you would have studied under section 10, where certain incomes are exempted from paying any tax. Those incomes are called as exempt incomes, and we commonly refer to section 10 as exemptions. Great. Good to see you all are doing good. Excellent. Nitish, I'll come to your doubts. Let me first start the session. I'll definitely address your doubt. So, I was saying that income tax law has different ways of giving you benefit. One is exemption, whereby certain incomes are not liable to pay tax. They are incomes, but the government feels that for the time being, they do not want to tax that income. If I have to give you the simplest example, we have agriculture income, then we have certain types of capital gains, then we have multiple exemptions relating to salary related items like HRA, children education allowance, etc. Similarly, retirement benefits like gratuity, leave salary, so many things. So different heads, different incomes are covered in the exemption list. Now, besides exemption, the second approach of giving benefit is by allowing you deductions. Now, somebody will ask me, sir, what is a deduction? See, go by the name. Deduction, as the name suggests, is something which shall be deducted. Now, from where this is deducted? So understand this, there are two types of deductions. One, deduction for expenses which you claim when you are computing that particular head income. Like when you computed salary, you had deduction under section 16. When you computed house property, you had deduction for municipal tax paid and then deduction under section 24. When you computed PGBP, you had deduction starting from 30 going up to 43 and so on. So the point is, first type of deduction is deduction allowed while computing the respective head income. Then comes the second deduction. Those deductions we have already studied in the respective heads. Then comes the second deduction, as you can see, which is called as deduction from gross total income. So wherever you have now computed your individual source income, then you have computed your individual head income, and you have made a total in the format. So now you reach the total of all your sources, all your heads, and that total is called as gross total income. In short, we call it as GTI. Now, the government wants to allow you some further deductions. Now, these deductions are allowed by way of giving you deduction under chapter 6A. Chapter 6A is the chapter which we normally refer to whenever we want to check these deductions. That is a deduction from gross total income. It is called as deduction under chapter 6A because it is given under chapter 6A of the Income Tax Act. Fine. Now, understand this point that whenever we are talking about deductions, a question will come why I need a separate chapter for deduction, or what is the difference between this deduction and the exemptions and the deductions that we studied in respective heads. Let me answer one by one. See, why you need a separate chapter? Because whatever you are going to study over here is different from exemptions and different from respective head incomes. Then comes the second corollary question: why are these different, or what is the difference? The answer is, understand this. When you are computing income, income means the net amount. In your accounting sense, it is the net profit. Now, how do you compute or find out net profit? You take the gross revenue in accounts, let us say it is your sales, and from that, you deduct all the expenses applying the matching principle. That is, those expenses which you incurred for earning those respective sources of income. So you get the net profit. Same logic is applied in the Income Tax Act, whereby respective head gives you certain deductions for certain expenses, which they feel is allowable while computing the income of that particular head. Now, this list keeps on changing. Over a period, there are amendments, certain deductions are deleted, some are substituted, some limits are changed. So, that is purely the prerogative of the Parliament to decide what expenses they want to allow you as deduction, but those are head specific or source specific expenses. Then comes exemptions. What are exemptions? They are not expenses. Exemptions rather are your incomes. Just a minute, please, students. Students, sorry, there was a very urgent call. Yes, I know I was on mute. I was intentionally on mute because I did not want my personal things to be communicated to y'all. Okay, fine. That was just on the lighter note. So I was saying exemptions are different from deductions. See, deductions are for some payments. Exemptions are for the source itself, like agriculture source is exempt or a particular capital gain source is exempt. So understand this particular point, that exemptions is very much different from deductions, because deductions will trigger or will arise only when you make some payment. In case of exemptions, where you are earning certain incomes, where the government or the parliament feels they want to exempt the source, they do not want to tax the source, then they provide you exemption. So exemption is for a particular source. So when I do not want to tax that source itself, I put it in section 10. Now coming to deductions, one is the matching principle of account, that when I'm computing income of any particular source, I want to know the net profit, how net profit would be computed, gross revenue, that is sales, minus the expenses. Now I'm using the word sales. For different heads, the word would be different. Like for salary, it would be gross salary. For house property, it would be GAV. But understand, generically, I'm using the word sales, which is the revenue of that particular head minus the expenses relatable to that head. That is what is deductions of specific head. Now we come to this third thing. So one is exemption, one is specific head deduction. The third is deduction from gross total income. Now, what is this deduction from gross total income? The deduction from gross total income is the deduction where, pay attention students, the deduction where you are made to invest in particular area, or you are made to start your business in a particular geographical area or in a particular sector. In other words, now understand the logic of this deduction under chapter 6A. Wherever the government wants to promote something, promote a particular investment, or promote a particular backward area, or promote a particular sector of business, they will say that, okay, you do this particular investment or payment or deposit, I give you deduction. Or you start your business in some northeastern area or in some second category district states which are not so developed, I will give you deduction. Or you start your business in a particular sector, like you set up a hospital having more than 100 beds, or you do a particular infrastructure development. So in all these cases, yes, Pallavi, correct, or even scientific research. So where the government wants to promote a particular area of investment, or a particular geographical area for its growth and development, or a particular sector, or a particular nature of income, they will say, you do this, I give you deduction. So that is the whole that is the whole logic of this deduction. Perfect. So SEZ is another example. 35AD business is another example. Now 35AD business is actually put in the PGBP head. Why? Because they are saying that it is business specific. So let us put it in PGBP head only, right? But here what we will find in chapter 6 is that they are giving you deduction based on either some investments, payments, or either on the basis of some particular sectors of income or a particular geographical area. So this is the whole ideology of chapter 6A deduction. And lastly, in chapter 6A, they also cover deduction for specified persons. Like if somebody is handicapped, they want to give deduction for handicaps. So they are putting a section for handicap. If somebody is having some disease, a terminal disease, they want to give some benefit to that person. So they are giving you deduction for people having some terminal diseases. So this is also there, but it is now very limited, that where the deduction is person specific. So this is broadly the ideology, the basis of giving you deductions. And why separate chapter? Because it is neither always in the nature of income, it is neither in the nature of expense of a particular head. So they wanted to keep it separately. And why separately? So that they can have independent provisions for this particular type of deduction. See, here also you'll find deduction for particular business incomes. So somebody will ask, sir, why not then put it in a respective business head? Because when it is put in the business head, it will also be affected by the various conditions over there. Now, let us say I want to give it a separate flavor. I want to give it some separate conditions. Instead of putting it over there, I am putting it in this separate chapter, so that whenever I want to stop these deductions, I'll simply remove this whole chapter. Everything is gone. So understand this, why a separate chapter is created and what is the difference between this deduction. No, beta, standard deduction is a deduction which is head specific deduction. Like you have standard deduction in salary, you have standard deduction in house property, you have standard deduction in other sources for family pension, for interest on compensation. Standard deduction is head specific deduction. In chapter 6A, you will not find any standard deduction. So chapter 6A is a very particular deduction. They want to promote something. Remember, this is the ideology. Either particular area of investment or particular geographical area or particular nature of source of income. And lastly, as I said, they want to give benefit to some persons. That is also what is covered in chapter 6A. Now, our module has classified all the deductions falling under chapter 6A into this category. First is deduction in respect of certain payments, then deduction in respect of certain nature of incomes, then deduction in respect of some other incomes, and then other deductions where I said it is for some particular persons. Now, actually, there are many more deductions besides this. In fact, a major category is not covered over here, which I was mentioning, deduction for a particular geographical area or for a particular source of income. That is not covered over here. Why? Because it is not part of your inter syllabus. But remember, you have a separate whole category of deductions where the deductions are given for particular area, that is geographical area if you are doing business in that area, or for a particular nature of business, but those deductions are not covered over here. Fine. Now, as you can see, all the sections or all the deductions are covered only in one section, that is section 80, with some alphabets given starting from A ending with U. Now you will say, sir, but we cannot see A because A, B, AB, all these are sections giving some conditions. So that will study. So section, obviously, if it has to start alphabetically, it will start with A only. But you can see the first section as 80C because the first deduction giving section is C. And the last deduction giving section is U. There are many more sections in between. As you can see, after G, we have directly jumped to J. So HI is missing, right? Why it is missing? Because it is not part of your syllabus. It will be taught in finals because it is covering a whole list of deductions which are either geographical area specific or a particular nature of business specific deductions. No, beta. Lahari Maroju. What is your first name? Lahari is your first name or Maroju is your first name? I means I should address by which name? Acha, Lahari. So Lahari beta, see, understand this. We will discuss this, that whether these deductions are applicable to individuals or these deductions are applicable to firm, that we'll discuss. So I'm just giving you a broad overview. We are going to go to specific deductions in detail. In fact, that is what is our whole 3 days, 3 sessions devoted to. Now, what we can understand from this table, which is very important, is that all these deductions from C to G are covering deductions where the law makes you or requires you to make some payment. So until and unless you have made that payment, I will not give you the deduction. That is what is C to G, where the heading given is deduction in respect of certain payments. Whereas these other deductions, like here, where they have written deduction in respect of certain incomes, again here they have written deduction in respect of other incomes. As you can understand from the name, you will be allowed deduction when you are working in a particular nature or category of income. That is where you are earning income from a particular source, you get deduction, obviously subject to satisfying some conditions. And then this last category, other deduction, is where it is specific to a person. Now, out of all these deductions, the most common ones are this, obviously 80C to 80G. If you would have solved your sums from salary head and other heads also, while computing those sums also, you may have come across reference to these deductions. These are very specific because they have limited applications, especially RRB, QQB, they have limited applications. Now, interestingly, as a student, when I see this list, what is my first biggest what word I can use? My first biggest challenge or my first biggest sardar this, sir, whether we have to remember the section numbers. That is the first question that every student asks. And especially when they see section number like this. My answer is yes, you should, because the more you write sections, somebody saying fear. Okay. So you can call it as put is Sir, how to learn them? Answer is, it is a very interesting way of learning them. The interesting way is, since some alphabets are used, try to make some synonyms, try to make some long forms out of that alphabet, and suddenly you will find that remembering them would be much, much easier. Now, sir, somebody will say, sir, how? I'll explain. I'll give you a few examples, though we'll be dealing with each and every section. I'll give you a few examples. See, this particular section, can you all see? A very strange section, 80QQB, right? Now, how do I remember what this section deals with? Firstly, its section deals with what? It is giving deduction to whom? It is giving deduction to authors who have written books. And what is the income for which this deduction is applicable? See, when as an author, I am writing book and my books are getting published, the publisher is giving me some royalty income. So the number of books get sold, I get royalty accordingly. Now, in this particular case, the deduction is for the royalty income which an author is earning from books, right? Now see how you can remember. QQB is what? As a student, you are asking this question to the author. What is your question? Q. Q banaye books. What is your question? What you are asking to the author? Q. Q banaye books. That is QQB. Once you understand this, see, this is my trick, right? So QQB is Q banaye books. Once this fits in your mind, you will never forget that 80QQB gives deduction to authors who have written books. Similarly, JJAA. What I have made out of this? JJAA is Do Gulam Do Ikke. We all have played cards. So JJAA is JJ is Gulam. So Do Gulam Do Ikke. And as you can see, this deduction has some linkage with employer-employee. So Do Gulam Do Ikke. Correct? Fine. It doesn't end here. I'll give you a few more examples because see, at least for 90% of this, you can have some very interesting long forms or some interesting things. See, G, something very interesting. Huh? G for God, and for God there is donation. Now I don't know whether for God there is donation or because you want donation you create God. That is a different thing. But G stands for God, and for God there is donation. That is why whenever you are making donations, for making donations you get deduction over here under 80G. Similarly, what is GG? GG is Ghar Ghuti. Ghar Ghuti. And what it deals with is, it deals with the rent that you are paying for the house in which you are staying. GG Ghar Ghuti. Right. Now, interestingly, see here, GGB, GGC. What was G? First G was God. And for God, there is donation. Now, 2G. Why? Because both these donations are for political parties. So what you give to God, you have to give X times more to a political party, and only then they are satisfied. And B and C are today India's two biggest political parties. So GGB and GGC is giving donations, is giving deduction for donations given to political parties. Why 2 times G? Because whatever you give to God, the political party requires much bigger donation. Correct? So that is why 2 times G. So it is X. We say a multiplier. So it is multiplier. And B and C are today India's biggest political parties. Right? Now somebody says, sir, what you have made for GGA? Same. G stands for donation and GA stands for the short form of Gaon. So G is donation, GA is short form of Gaon. So it is donation for Gaon. If you see, you will find here donations for rural development, poverty eradication, backward, etc., upliftment, etc. So GGA is donation, G for God, that is donation, and GA is the short form of GAO. So it is donation for rural development, poverty eradication, all those things which are related to GAO. Correct. It is not ending here. See, we have so many interesting insights in this. So just be focused, right? Should we start? Anybody, any questions up to this point? Yes. Acha. I'm not saying you follow what I'm giving. You can have your own. Hardik, sir, why you want everything that I should give? Now, if I have given you some trick, if I have given you some examples, why don't you give me something? Yes. See, small things you can always then remember, Praveen. So first you understand it is for political parties, then the other small things that you can remember, that B is for company, C is for individual, that you can always make up and remember, right? Yes, Pallavi. All these deductions you will deduct once you reach the figure of GTI, that is gross total income. That is, these have nothing to do with respective heads. These will be deducted once you have computed income losses of all heads, added, and you have made a total after setting off all the losses. Correct? Fine. Now, I want your creativity to start working. Make your own long forms, right? Yes, Nitish, external deductions. Yes, Hardik, you should. Now, so first they have also given you example of what are some common exemptions. This is what you have already studied in the chapter of salary, right? Perfect. Nitish, perfect. This is what I have also made. We'll come to that, beta. Vinuta will get to know everything. See why I'm not answering all your questions upfront, because if I start answering all your questions upfront, your interest and the inquisitiveness of this chapter will go. So my role is not only to teach, because now you all are all grown up, you all can study. It is simple English. My question is more to entice that curiosity of reading that particular topic. In fact, I want that whatever sections I cover today, when I come back in the next session on the same topic, I should not be the person who should be explaining. It should be the other way around. I would be asking questions on the sections, and you have to give me the answer that, okay, this section deals with this section gives deduction for this. Fine. So let us go to that mode of study, because otherwise, see, this chapter, the another chapter, TDS, can be very lengthy, can be very heavy, because there are many section numbers and there are many technical things. So the best way of getting interest in all this is trying to be creative with the chapter. And you can be creative with the chapter in any manner. Like here, I try to be creative with the section number. So it also helps me in remembering the section number. Plus, because now there is something creative, na, suddenly your mind responds better. Otherwise, it starts getting monotonous. It starts getting very heavy, such a long chapter, so many sections. But now it will be more interesting, because you have something to deal with. Okay. Now, we have broadly two types of deductions from gross total income. One is deduction under Chapter 6A, all the sections you saw in the previous chart. And the other one is deduction under Section 10AA. Now, what is deduction under Section 10AA? It is covering deductions for SEZ unit. So as I said, all these deductions are for promoting something. So now the government has come up with a new industrial policy, which is categorized as SEZ. You have EOUs, SEZ, FTZ, FTWZ, all those things. So for SEZs, the deduction is under Section 10AA. Now here in this table, they have tried to differentiate between deductions and exemptions, so that we have already discussed. Exemptions are for incomes and deductions are for your payments and contributions. Okay. Now we start with the section. As I said, 80A, 80B, 80BA, all these deals with the conditions that are Nitish, good one. Okay. So all these deals with some conditions given relating to these deductions. We'll just go through them. It is not necessary that you learn them for your theory, because there will be no theory question asking this particular section. But yes, see, this entire chapter is mainly used in practical whenever you are solving your total income or computation of income sums or computation of tax sums. These all things would be given in the sum. So till now in your sums, you mainly had the details relating to income and expenses, which you use to compute the final income of that particular head. Now, this chapter will also be used for all practical sums only, whereby you would be given details for whatever we are studying, and you have to simply check the details, apply the conditions that we are going to study over here, and check whether you are satisfying the conditions given over here. If yes, then you will subtract that much amount from the gross total income. So this is the basic purpose of this chapter, that we have to study each section in detail, understanding the conditions given for each section, remembering those conditions, so that when we are given this particular information in the sum, we will apply these conditions to check that whether I satisfy the condition of that section. And if the answer is yes, you have to simply deduct that amount subject to the conditions, restriction, or maximum limit, whatever you are going to study, from the GTI. That's it. That is the role of this whole chapter. Now, what are the conditions? 80A1 says that Section 81A provides that in computing total income of assessee, there shall be allowed deduction from his gross total income starting from 80C to 80U. So simply it says that when you are computing your income, we will allow you these deductions. However, what is the main condition? If assessee has exercised the option of opting out of the default regime. In other words, these deductions are not allowed under the new regime. However, there is an exception, and I think it is mentioned here. Yes, I think it is mentioned here. So I'll just read from here itself. So firstly, whatever deductions we are studying, all these deductions are not allowed if you are in the default or the new regime, right? So none of this will be subtracted. That is, when you are computing your income by the default regime, you don't have to subtract any of these. However, there is an exception. What is the exception? Deductions under 80 CCD bracket 2. So we have 80 CCD. It has subsection 1, subsection 1A, subsection 2. It has 3 deductions. Out of 3, only 1 is allowed, which is given in subsection 2. What it is, that I'll explain later. Similarly, deduction under 80 CCH subsection 2. And next is JJAA. These are the only 3 deductions which are allowed when you are computing income as per the default, that is the new regime. CCD2, 80 CCH2, and 80 JJAA. Only these 3 deductions out of the entire list will be allowed. So this is also what is the first condition, that these deductions are allowed only when you are in the old scheme, that is, you have opted out of the default regime. Second, the aggregate amount of deductions under this chapter shall not in any case exceed the GTI. Now this is interesting. See why this point is mentioned, because as I mentioned, you have 2 deductions. One is income specific or head specific deductions, and the other one is this chapter 6A deduction. Now, when you are having head specific deduction, you would have studied in respective heads like house property, PGBP, capital, that if those expenses are greater than the amount of income or the amount of revenue of that particular head, it results in a loss. Like in capital gain, if your cost of acquisition or index cost of acquisition is greater than the full value, the difference is a short-term or long-term capital loss. Similarly, in PGBP head, if the total of expenses is greater than the sales, the difference is your PGBP loss. If under HP head, the interest amount, which is in case of self-occupied up to the limit of 2 lakhs, 30,000, whatever it is, it becomes your loss. So different heads are providing different expenses deduction. And if those expense deduction are greater than your revenue of that particular head, it becomes a loss. However, what is understood from this subsection 2 is that if your deduction under chapter 6A is greater than the GTI, it will never become a loss, because subsection 2 restricts the total amount of deduction up to the amount of income itself. So let us say your GTI is 12 lakhs and all sections added 80C to 80U is 15 lakhs. It means that your deduction is greater than your total income. So whether the excess deduction, which in my example is 3 lakhs, will become a loss, answer is no. And the moment I say it is not a loss, it also means that you cannot carry forward the deduction, because what you can carry forward is only loss. If the deduction itself is not allowed, which deduction? The excess amount. So GTI is 12 lakhs, total of 80C to 80U is 15 lakhs. This excess 3 lakhs is not allowed in the first place. When it is not allowed in the first place, there is no question of it becoming a loss. There is no question of you carrying forward that amount. Fine. Third is a very logical point. If AOP BOI is opting out of the default regime, that it is getting covered in the old regime, and if any deduction is admissible under these sections, no deduction under the same section shall be made in computing the total income of the members. In other words, once you allow a deduction to the firm, here firm means the AOP BOI, for the same amount, you cannot allow deduction to its members. Logical? Same thing cannot be allowed twice. Similar logical point is point 4. See, point 3 you can ignore, it is of no use because AOP BOI is not applicable to us. Point 4. What is point 4? Where you are allowed deduction under section 10AA. What is 10AA? 10AA is SEZ. Or under any provisions of chapter 6A, what we are studying, under heading C. What is this heading C? Heading C is those sections which is not part of your syllabus, which I was mentioning at the start. It is deduction when you are starting your business in some northeastern states or some backward districts of particular state, or when you are starting a particular type of nature of business, or you are earning income from a particular type of business or source which the government wants to promote. Those deductions are covered in 80I, IAIB, ICID, etc. But fortunately, it is not part of your syllabus, but just for you to understand, whenever they say that we are talking about chapter 6A deduction, but which deduction? Heading C. And what is the name of this deduction? Deduction in respect of certain incomes, because all these are incomes only from either backward area or backward district business or a particular nature of business. In that particular case, what they are saying, if I'm already allowing you deduction under 10AA, why? Because you are SEZ. And that SEZ you have started in a backward district, which is again having a deduction under heading C. Whether for the same purpose, can I allow you two deductions, one under 10AA because you are SEZ, and again under chapter 6A heading C. Why? Because this SEZ is in backward area. Answer is no. So that is what is clarified in point 4. That for same reason, I will not allow deduction under two different heads or two different sections. Again, further, they are saying the deduction referred to in clause 4, that is this deduction, shall not exceed the profits and gains of the undertaking or unit or enterprise or eligible business as the case may be. In simple words, you have first computed income of SEZ, you have first computed income of that particular backward state business, and that income is part of your PGBP. Now, when you are allowed deduction under chapter 6A under any of these categories, you can deduct only that much amount which you have firstly included in income in PGBP. In other words, what is included in PGBP for any of these businesses can only maximum be allowed as deduction below, or in other words, your deduction from these specific businesses cannot exceed the income. In other words, what you have included in income, only up to that much amount you can claim deduction. Again, what it's saying, no deduction under any of the provisions referred to in clause 4. What is clause 4? 10AA, that is SEZ, or heading C, that is businesses in backward area, backward states, or some specified category of businesses. So for this, what is another condition? They shall be allowed if deduction has not been claimed in the return of income. So what it says, when you are filing the return of income, now I'm sure you all would be knowing what is return of income. It is the details of your income which you submit to the government in a specified format. That format is called as return of income. Now, in that format, you have a column for chapter 6A deduction. You have column for everything, for writing your residential status, for writing the previous year, for writing all these heads of income and giving details of each head. You have columns for everything. Now, in that you have a column for chapter 6A. Now, let us say you are having any of these deductions which are applicable to you, SEZ deduction or any of these backward area deductions, but you forgot to show it in your returns. What does this condition subsection 5 says? If you have not shown that deduction in your returns, you cannot claim that deduction. In other words, the government will not allow you deduction automatically. If you want, you have to claim. सो ऐसा वो बोलते हैं ना हिंदी में कि भाई बिना रोए माँ भी बच्चे को खाना नहीं देती। तो वैसे ही जब तक आप क्लेम नहीं करोगे रिटर्न्स में, द गवर्नमेंट विल नॉट गिव यू द डिडक्शंस which are falling in point number 4 above. Then what is this condition? Now this is an interesting condition. Let us understand this condition. I have one business which is falling in this special category eligible for deduction. Let us say it is a construction business. I am doing infrastructure development. That is, I am constructing roads, flyovers, metros, etc., which is eligible for deduction under heading C because it is infrastructure business. I have another business which is manufacturing of cement, which is not covered in any of these deductions. So I have two businesses, one covered in some deduction. Let me call it as eligible business. Second, not covered in any deduction. I will call it as normal business. Now, I know that whatever profit I'm earning from the eligible business, even if it is 100 crores or 1000 crores, the entire profit I will get as deduction below. Below means when I'm computing GTI, from that I will deduct deduction under chapter 6A, and that 1000 crores I will get deduction under some of the sections of ITI, IB, ICID, etc. Now, I know further that this cement business, which is a regular business, has no deduction. So there is deduction for which business? The special business, eligible business. There is no deduction for which? For the cement business. Now, having understood this, now understand simple mathematics. Not even mathematics, I'll say simple jugaad. For this infrastructure business where I construct roads, where I construct all these flyovers, etc., cement and steel are the two major inputs. Obviously, since I have my own cement factory, I am manufacturing cement there and sending the cement to my infrastructure business. Great, no problem. Government has no problem at all. But what jugaad I am doing? Let us say my one cement bag cost me 5,000, or it is the market value of cement bag is 5,000. However, the cement bag, when I'm supplying to this infrastructure business, instead of showing 5,000, which is the fair market value, I am showing only 100 rupees. What will be the impact of this? The impact of this will be that since I'm showing a lower sales value in my cement business will report a loss. And my this special business, that is this infrastructure business, which is eligible for deduction under ITI, IB, IC, etc., will show abnormally high profits. Now, what is the jugaad? What is that special planning or evasion I am doing? I will, whatever profit I will show in my special business, anyways, even if it is 1000 crores, I'm not worried because I know I'll get the deduction of entire 1000 crores. And whatever loss I'm reporting in the cement business, I will set it off against my other businesses, which are also regular business, thereby reducing their profits and ultimately not paying tax on those other incomes also. So this cement loss, let us say I have multiple business, restaurant business, hotel business, so many businesses, which are all profit making. In fact, cement was also profit making, but because I reported the sales at only rupees 100 per bag instead of 5,000 per bag, hence this became a loss. And since this became a loss, this loss will reduce my other PGBP incomes. So those profit making businesses also income gets knocked off because it gets set off against my loss. And whatever 1,000 crores law profit I'm showing in my infrastructure business, I'm not worried because below the line, that is after GTI, that will also get deduction. So effectively, I'll end up paying no tax by doing a simple jugaad. What is the jugaad? Within my business, I am transferring the good services not at fair market value in such a manner that special business gets benefit and regular business shows loss. If I'm doing any such jugaad, it will not be allowed because now subsection 6, which was introduced later after understanding that people are doing this, says that in such a case, I will have to compulsorily show the supply of these goods and services within these two units at the fair market value of such goods and services. And how fair market value is determined, they have given that also. So the point is, I cannot claim such a price which will result in higher profit in the special business and losses in the regular business. So to avoid that, they have said that your inter-business transfers would be valued at fair market value. Fine. Now, again, the same deduction under heading C, that is for some specified businesses in backward area, and also deduction under 35 AD, which we have already studied in PGVP, which is again for specific businesses. Like if you remember, honey bee business was covered in 35 AD. If you remember, cross-country pipeline business was covered in 35 AD. Now, let us say I am in the business of rearing these honeybees for getting the honey and wax. And this business, I am starting in backward area. Now, what is the advantage? 35 AD is already giving me special deduction for this business. And since I've started this business in backward area, I'm also eligible for deduction under Chapter 6A for the backward area. In that case, again for the same activity, for the same business, I'm eligible for two special benefits. What it says again, I will not allow you to claim this deduction in both the categories. So either you claim it under this category of Chapter 6A or you claim it under 35AD because I will not allow you to claim both. So if you have claimed here, no deduction under this is permissible. Vice versa, if you are claiming here, no deduction under Chapter 6A would be permissible. This is same like the above point number 4, where they were comparing SEZ with heading C. Now they are comparing 35 AD with heading C. The answer, the logic remains same. All this was 80A. Now you have 80B. What 80B says? Deductions in Chapter 6A under heading C. Again, deduction in respect of certain income shall be allowed only to the extent such income is computed as per the Income Tax Act. In short, even though these incomes are eligible for deduction, you have to first compute them, and the computation has to be strictly as per the Income Tax Act. So you compute as per Income Tax Act, first show it in your PGBP, again come down and show it as deduction under Chapter 6A. Again, new section added 80AC, what it says? Furnishing return of income on or before due date mandatory for claiming deduction under Chapter 6A heading C. So again, for these businesses which are falling in Chapter 6A heading C, if you want to claim the deduction, you have to file the return within the timeline. If you are either not filing the return or your return filed is after the timeline, that is after the due date, you will not get deduction. Now here they have given you the list of those sections. As I said, IA, IB, IAB, IC. There are multiple sections which are giving deductions under heading C. Fortunately, they are not part of your syllabus. Out of all this entire list, you can see that we have only 80 JJA, 80 QQB, 80 RRB. So out of this entire list of heading C, we have only 3 sections which are applicable to our syllabus. Remaining all sections are not part of your inter-syllabus. Fine. Now, ATB 5 says what? Gross total income means the total income computed in accordance with the provisions of this act without making any deductions under Chapter 6A. Obviously, that is what is GTI, because after you deduct Chapter 6A, it becomes TI. TI means total income. So what is GTI? GTI is the income before allowing deductions. Now, computed in accordance with the provisions of this act, what does this phrase mean? It means that deductions under appropriate sections have already been given effect. So you should claim deduction under respective head. Second, income of other persons has been included, so you should do clubbing. Third, interhead adjustment of losses, so you should do set off. And last, unabsorbed brought forward business loss, depreciation loss has been set off. In other words, see, anyways, we reach GTI after doing all this. First, respective head computation by allowing deduction of respective heads. Two, by doing clubbing. Three, by even adjusting losses. So after doing all this, what you get is your GTI. And then from GTI, you deduct deduction under Chapter 6A as per the conditions what you satisfied, and deduction under Section 10AA wherever it is applicable. Fine. Okay. Now, after understanding the basic conditions, we now move on to the deductions. The first section of deduction is 80C. Here, C has two meanings. One, C means what? देखो, मैं कितना दिलदार हूं, मैंने आपको कितने सारे चीजों का डिडक्शन दिया है. Because this section gives you deduction for so many payments. The longest section of this, see the list. See the list. So for so many items, this section is giving you deduction. So the list is huge. Now, since this section is giving you deduction for so many items, the first meaning of C means dekho. See, for how many items I am giving you deduction, I am so much dildar, right? But there is one more meaning of C. C for selfish. I repeat, what is the second C? No, Bhavana, not that C. Not that C. The second C meaning or elongation of C is C for selfish. Yes, Nitish. Please don't try to find logics. In fact, your mind will never remember logics. It will always remember illogical logics. Okay. But somebody will say, sir, where selfish comes over here? We are not talking about personal things. We are talking about section. We are talking about deduction. So how come you are introducing some nature over here? Selfish. I'll tell you why I have used the word selfish for C. So firstly, the first meaning of C is dekho. See how many deductions I have given in one section itself, right? Why I am saying the second meaning is selfish, because let me take you back to this chart. Okay. Now see, I am not able to enlarge this page. Yes. Okay. Now see, 80C is giving deduction because you are making payment in so many things. You are around having 21, 22 things or areas of investment. Similarly, 80D, 80DD, 80DDB, all these are dealing with investments. Now, I have not mentioned the sections interim, which is CCC, CCD, CCH, because these are only investment for individuals. But here in 80C, 80D, 80DD, the payments that we are going to study are applicable even to one person, and it is applicable even to your family. I'll give you example. Now, as you can see from the name, what is covered in 80C, one of the items is LIP. LIP is life insurance premium. Now, as I said, these three sections, 80C, 80D, 80DD, these sections cover those payments which can be made for individual also and which can be made for their family also. Now pay attention. 80C, when I'm making payment, C for selfish, which means you get deduction only when you are making payment for your selfish family. What is selfish family? It is today's 21st century family where it is husband, wife, and children. That's it. Nobody else. So for me, C means selfish family. So I am making payment of life insurance either for myself or for my wife or for my children. I get deduction. If I'm making payment of life insurance of my brother, sister, my parents, I don't get deduction. C, selfish family. Correct. But when you come to D, which we are going to study, it is again in respect of premium, but which premium is covered? Medical insurance. We all know mediclaim policy premium, medical insurance premium, we all know. Now in D, they have added one more family member because C ke baad D aata hai. So they have, as you are progressing with the section, they are adding one family member. So in D, besides these three persons, which is the selfish family, they have added one more family member. Who is this one more family members? Your parents. When you go to DD and DDB, which is again relating to some medical treatment payment, they have added one more family member. So C for selfish. Who was selfish? Yourself, spouse, children. 80D added one more family member to this. It added your parents. 80DD DDB adds one more family member to this. Your brothers and sisters. So see, as the section progresses, they are adding one family member. But for C purposes, wherever you are making payment for family, C will give you deduction only when you are making payment for selfish family. That is why I said C for selfish. Is this clear to all? See, these are some logics how you can remember the technical sections and the technical conditions. So C for selfish, which covers three persons. You go to D, you add one more person. You go to DDB, DDB, you add one more person. So this is how you add one person. One person means like for 80D, if you make payment for your selfish family, or even if you make payment for your parents, you get deduction. But for 80C, if you make payment for your parents, you don't get deduction. That is what is the point. Okay. Now, we have to understand few things in every section. First, the deduction is allowed to whom? That is whether to individual or to HUF or to partnership or to company whom. So we have to first understand who is the eligible assessee. Second, which payment is covered under that section? Third, is there a limit up to which that section will allow deduction? So these are the three questions for which you have to search answer in all these sections relating to payment, right? Now, As we see, ATC says that the payment which is made either by an individual and in some cases by HUF is what is covered under ATC. So if a partnership firm or a AOP or a company makes any of these payments, no deduction allowed. Deduction is allowed only where the payment is made either by an individual or by a HUF. Again, when they have opted out of the scheme, that is, they are covered in the old regime. That anyways, we have seen at the start, only 3 deductions are allowed in the new regime. Remaining all deductions will not be allowed if you are in the new, that is a default regime. But if you are in the old regime, all these deductions are allowed. Now, what is the limit given? The maximum limit that is applicable for ATC is 1,50,000. So section ATC limit is 1,50,000. All these payments combined. So whatever payments we are going to read now in the list of ATC, all these sections combined, all these payments combined, the limit is 1,50,000. What are these payments? Contribution to unit linked insurance plan, contribution to unit linked insurance plan of LIC mutual fund. So both these are insurance linked plan. You can simply remember ULIP. So contribution to ULIP. Next, premium paid in respect of life insurance policy. This is the most important one because this is most commonly asked also. Now here comes the question. In whose name are you making payment so that you get deduction? If you see everywhere it is selfish family. Yourself, spouse, children. Then yourself, spouse, children. Yourself, spouse, children. That is why I said that it is dealing with selfish family. Here, if you are making payment for your parents for life insurance premium, you get no deduction anywhere. If you are making payment for your brothers and sisters, you don't get deduction anywhere. If it is for life insurance, if it is for any of the payments that we are going to study in this section. Correct? Now, within life insurance, there is again something. Now for this, let us first take a practical example. What is given in the question? The question says, Vishal, you are doing computation of Vishal, chartered accountant, provides following details. In the details, it is given that during the year, Vishal has paid life insurance premium of himself, of his wife, of his 2 children, of his parents, of his brother. Now you have to first strike out the payments which I have made for my parents, for my brother. Why? Because they are not going to be covered in ATC because C is for selfish family. So the payments which I have made for my parents, for my brother, or for my sister, or anybody except these 3, remove it. Now comes the next question. Somebody has also asked in chat. I purposefully did not answer that. I'm answering it now. Whether minor children are covered or even major are covered, whether married children are covered or only unmarried are covered, answer is the law has not put any condition. So even if my children are major, that is, my children have attained the age of 18, they may have even started earning their own income. If still I am paying their premium, I still get deduction. Because here, when you are reading this, they have not put any qualification or condition, that is, whether my child should be minor, whether my child should be dependent, whether my child should be married or unmarried. Nothing is given. Correct? Now, see, I'm not using the same terminology for a spouse, that whether my spouse is minor, whether my spouse is unmarried. I'm sure this would be absurd. So obviously, spouse is major, spouse is married, then only she is spouse or he is spouse. Correct? So please don't, nobody ask me that question, sir, what about spouse, whether married, unmarried, whether major, minor? Manvi, but I have just clarified that. Why are we only thinking about married daughters? The law has not given any condition. So even if I am making payment for my daughter who is major, who is self-dependent, and also now let us say she is married. still I am getting deduction. Why? Because the law has not put any condition. It simply says any child. They could have put the condition unmarried. They could have put the condition married daughter, minor married daughter, whatever. They have not put any such condition. Correct? Okay. So see, you can see the effect of selfish family. Now see, there would be exception to this rule. One or two places you may not find the selfish family rule in this list, but otherwise majorly see for selfish. Now we were discussing the detailings of this. Now the question says Vishal has made payment for himself, for wife, for two children. Remaining payments, whatever I have made for life insurance, you should simply strike out so that you don't waste time in the question. And you just put a note in the exam below your main answer that payment made for person other than individual spouse, etc. is not eligible. Simple. Now somebody is asking, sir, मतलब married daughter के नेम से उसके फादर, उसके हस्बैंड दोनों को डिडक्शन मिल सकता है क्या, या किसी एक को ही डिडक्शन मिलेगा? फर्स्टली टेल मी, why are you all being so gender biased? Even Manvi, even you, Nitish, why are you only bothered about married daughter? Why not married son? Can't this question also apply to married son? That what will happen if there is a married son and the payment is made by his wife also and by his father also? Possible, na? So, first the answer is whether it is married son, married daughter, once you get married, the deduction is allowed to two persons, rather three persons. One, you are making premium payment of your own premium, you get deduction. Second, let us say my example. So I am making payment of my premium, I get deduction. If for my premium, my wife is making payment, she will get deduction. So deduction will be allowed only once. If I make my premium payment, I get deduction. If my wife makes, she gets deduction. If my parents make for me, they get deduction because for them, I'm a child. Married, major, dependent is not a condition over here. So my insurance policy, right? I make payment of premium. Acha, interestingly, this year I make, next year my wife makes, the third year for the same policy my parent makes. Every year, whoever is making payment will get deduction. But let us say in some other year, in the fourth year, my daughter, who is now earning, is making payment of my insurance policy in the fourth year. So first year I'm making payment for my own policy, I get deduction. Second year my wife is making payment for my policy, she gets deduction. Third year my parents are making payment for my policy, they get deduction. Fourth year, my daughter, who is now earning, is making payment of my policies. The policy is same, but different people are making payment in the different year. Now, in the fourth year, when my daughter is making payment, she will or she will not get deduction. Good. So everybody is clear. Everybody is on the spot. So she will not get deduction. Correct? Good. I hope I have answered the questions, whatever you all have raised till now. Yes, you can call it as investment linked deductions because anyways, our model has also said a deduction on the basis of payment. So you call it as investment link or you can call it as payment link deduction. Correct. Now, as far as insurance policy is concerned, there is some internal limit. What is this internal limit? Lahari, give me some time. I'll answer your question. So, in my example, as I said, I have made payment for multiple life insurance premium. You have erased or striked out others. You have kept only three. Payment made for my own policy, Payment made by me for my wife's policy, payment made by me for my children policy. Now, in that, what are the further details given? The payment which I'm making for my policy was taken in the year 2008. The policy is of 10 lakhs. And the premium which I am paying is rupees 80,000. I repeat, the policy is of 10 lakhs. The policy is taken in the year 2008 and the premium which I am paying is rupees 80,000. So firstly, payment made for my own policy eligible? Yes, but now there is a limit. What is the limit? The limit depends upon when the policy was taken. If the policy is taken up to 31st March 2012, then premium up to 20% of the sum assured is the policy amount for simple, will be allowed. However, if the policy is taken from this date onwards, that is after 31st March 12, not 13, after 31st March 12, if the policy is taken, then the limit becomes 10%. What is that 10% given? Yes. Now, understand this point. So where policy, this is your cutoff date. Policy is taken up to this date, that is 31st March 2012. Premium paid up to 20% of the policy amount is allowed. However, if the policy is taken on or after 1st April 2012, premium up to 10% of the policy amount is allowed. So in my example, my policy of 2008, policy amount is 10 lakhs. Premium which I am paying is 80,000. Will 80,000 be allowed? Yes, others? No, beta. Lahiri, why you are saying up to 1 lakh? It cannot be up to 1 lakh, beta. My policy amount is 10 lakhs. Premium paid is 80,000 and the policy is taken in 2008. Whether I will get deduction? Obviously, answer is yes, because for my own policy, I get deduction. The question is up to what amount? Answer is up to 80,000, not 20% or 2 lakhs. 2 lakhs is the limit. But if I am not paid 2 lakhs, how can I get deduction of 2 lakhs? So in this example, how much deduction I'll be eligible? I'll be eligible to take 80,000. Correct? Now, adding further, I've also taken my wife's policy, which is also of 10 lakhs. This policy I have taken in the year 2014. So my wife's policy, 10 lakhs, is taken in the year 2014. Acha. Please don't get misguided by this up to 2013. It has some other relevance, and the relevance is for disabled person. So for normal persons, the only cutoff date is before 31st March 12 and after 31st March 12. Now, I have taken policy for my wife, policies of 10 lakhs, and I have taken it in 2014. And again, let us say the premium is 1,20,000. So policy 10 lakhs, premium is 1,20,000 and policy taken in 2014. What is the amount which I am eligible to claim for this second policy? Oh, Kambeshwari is saying nothing. Answer is 1 lakh. Why 1 lakh? Because if the policy is taken after 2012, which is my case because I've taken in 2014, now the maximum amount which I can claim as deduction is 10% of the policy amount. My policy amount is 10 lakhs. 10% comes to 1 lakh. I have paid 120. I cannot exceed this 10%. So for me, the eligible amount is 1 lakh. Correct? I hope this is clear to all. Now there are two persons who have asked the same question. One is Abhishek and I think Riddhi had asked the same question. If in so many messages, I read that, but I did not want to break the link of my discussion, so I did not answer. Yes, I think Riddhi. Now, you have studied something in relation to life insurance even in other sources, right? Now, Riddhi and who else? Yes, Abhishek. They are asking me, sir, is there a link between these two? And secondly, why means is there something Manvi, but I said na ignore. I'll tell you what is that 2013. So for the time being, ignore that 2013. Now pay attention. What is the connection of other sources and this chapter 80C section? Both are addressing life insurance. The difference is in other sources, what is covered is the policy amount in the year when you receive the policy. So let us say that 10 lakhs policy is maturing in this year for me. If I receive that 10 lakhs policy today, that will go to IFOS, income from other sources. And then over there, I have to check whether it will be eligible as exemption under 1010D. Now, interestingly, what does IFOS says as far as 1010D is concerned? It says that when it will be exempt over there, one, if it is received on death, two, if it is not received on that, it is received on maturity. Like in my case, since the policy has matured, the total period of policy is over, I am receiving that amount. In my case, exemption would be allowed if the premium which I have been paying for this policy was within the ATC limit, that is of this 10%, 20% as the case may be. So if my premium paid was within the ATC limit, then today when I receive the policy amount on its maturity, it will be exempt under 1010D. So that is what is the connection of IFOS, 1010D and ATC. Right? Hardik, I did not get what is your 50,000 aggregate premium paid amount. I did not understand your question, Hardik. So you are saying, and sir, will 50,000 of aggregate premium paid amount come here as well? What is that 50,000 of aggregate premium paid amount? Are you talking about 80CCD, which is the premium of, I forgot the name of that policy, National Pension Scheme? Are you talking about that 50,000? Okay, see, that is the limit. Acha, that 50,000 are talking about. Tambeshwar is asking which section exempt the maturity. It is exempt under 1010D. See, there is a limit. Every section has a limit. Like here for deduction, you have a limit of 150. Similarly, the exemption may also have a limit. So you have to go and check what is the amount of limit given over there, right? Now, I think Manvi, 2013. I said ignore 2013, right? Why? Firstly, what it says in respect of policies issued after 2013, A point says the limit is 15, B point says the limit is 10, right? What is A point dealing with? Where the insurance is on the life of the person who is suffering with disability. So for disabled persons, From 2013, the limit has been raised to 15%. But when we are talking about normal persons like you and me, the limit even after 2013 is 10%. So that is why I said for all of us, remember the cutoff date as 2012. If the policy was taken before 2012, the limit of 20% applies. If the policy is taken after 2012, any year, don't look at this 2013. After 2012, any year the policy is taken, the limit is 10%. Here also it is 10%. Here also it is 10%. Only what has changed is if a person is a disabled person and the policy is taken out for a disabled person, up to 2012, the limit is 20%. Between 2012 to 2030, that is during this 1 year, the limit is 10%. And beyond 2013, for disabled person, the limit has become 15%. So for disabled person, there are three limits. Up to 2012, 20%. In the year, financial year 12-13, 10%. And beyond 13, that is beyond 1st April 13, it is 15%. But you may safely keep this aside because that may not be so much relevant in exams. But yes, those whoever can remember, recall all these things, please remember out of 10 paper, one paper may even cover this technical point of 10 and 15% difference. Otherwise, you can comfortably keep the 15% point aside. Only remember the rule applicable to normal persons 2012, 20%, after 2012, 10%. Is this fine? Any questions up to this point, students? Yes. So should I proceed? Tambeshwari, Rashmi, Hardik, Abhishek, Manvi, whoever has questions, I hope your questions till now have been answered. Great. Now, the next payment, which is simple, premium paid in respect of contract for deferred annuity. See, these are different types of policies that you take. Next, any sum deducted from salary payable of a government employee for securing deferred annuity. Again, it is deferred annuity only it is for government employee. Next, this you have studied in salary chapter, where you as an employee are contributing to provident fund. Now, one contribution is by your employer also. You don't get deduction for your employer's contribution. You get deduction only for your contribution. Now, if you remember, you studied SPF, you studied RPF, you studied URPF. URPF, if you are contributing, you don't get deduction because the name is not there also. So, where you are making payment to RPF, that is recognized provident fund, only then you are eligible for deduction. If you are making payment to URPF, you are not eligible for deduction. Annuity means where, see, in life insurance or regular insurance, what you pay is called as premium. Then against that, there is another policy called as an annuity policy. Annuity policy is similar to, you can say, life insurance policy, but it is a different product made by the life insurance company where they call it as annuity plans, where generally the premium has to be paid once. That is where it is annuity plan, right? Yes. Now Shibu has raised a very good point. Yes, sir, I am making 4 or 5 payments like life insurance also. Like in my example, I have made life insurance for myself, wife, and both children. All are eligible. I add up. Then I make all these payments also. I add up. I add up all these 23 payments, whatever I'm making, and this total comes to rupees 1,75,000. So firstly, you check all these eligible payments, which we are studying in 80C. Whatever is the eligible amount for each payment, that you will check and you make a total only of the eligible amounts. That total is 175. Now, when I'm deducting the amount from my GTI, I will deduct 1,50,000 because 150 is the total limit for entire 80C. Somebody else had this question earlier. I intentfully did not answer then because I did not want to mix too many things at the same time. So now I'm answering this. So I have made multiple life insurance payments. Out of that, whatever are ineligible, like parents, brothers, sisters, I have striked out. I have not considered them. Similarly, whatever payment I have made for myself, my wife, children, I will consider that, but only up to the limit. Like in my case, if the limit is 1 lakh, I can take only 1 lakh. In my wife's case, if the limit is 80,000, I'll take 80,000. So whatever is the eligible amount, I will write those eligible amounts. I'll make a total of all the eligible payments falling in 80C. This total, let us say, is coming to 1,10,000. So I will take deduction of 80C 1,10,000. If this total is coming to 1,75,000, I'll take deduction 80C 1,50,000. I hope this is clear to everyone. Yes, students. Good. Now, similarly, you have contribution to approved superannuation fund. That is also eligible. Very important. You make contribution to Sukanya Samruddhi account. Now, what is Sukanya Samruddhi account? I think in 2014, when Modi ji came for the first time, he started this special scheme for female child, whereby I can open a special account in the name of my girl child, female child, and whatever contributions I'm making in that account, that contribution will be firstly eligible for 80C deduction, which we are studying. Further, as you can read over here, whenever I will get this amount back on maturity, it should become taxable, but it will not be taxable. Why? Because whatever I receive on maturity is again going to be exempt under section 10, clause 11A. So whatever I'm depositing now is eligible for deduction in 80C. Whatever I'll be withdrawing will be exempt under 10 bracket 11A. Next is I have taken out NSC, National Savings Certificate. Right now, the issue which is going on is 8th issue. So it is called as NSC 8. Now, different periods of time, government has brought different schemes of NSC. So you have scheme 1, scheme 2, scheme 3, scheme 4. Today, the scheme which is running is scheme number 8. So we call it as NSC 8. It is a scheme of government. If you invest your money in that particular scheme, you are eligible for deduction. Bhavna, see, where there is no individual limit given, like for Sukanya, there is no individual limit given. For approved annuation fund, no individual limit is given. Then your overall limit for 80C is 150. Individually, you can put any amount. So let us say I've put, example, I've put 2 lakhs. I'll take entire 2 lakhs over there because there is no individual limit for Sukanya Samruddhi. I will put that entire 2 lakhs, let us say. And when I'm making total of 80C, anyways, maximum what I will get is 150. So your question is right. We had individual limit for life insurance premium. So do we have individual limit for everything? Answer is no. Only for life insurance, I have individual limit. For others, whatever payments are eligible, just put it down in the list, make a total of the list and compare it once with 150. And next is contribution to approved annuity plan of LIC, contribution towards notify units of mutual funds or UTI, contribution to notified pension fund set up by mutual funds or UTI, contribution to National Housing Bank, subscription to notified deposit schemes. Now, what is notified? They have mentioned. Then payment of tuition fees. Now, this is again important. Now, there is a lot of misunderstanding about this. Now, when they have used the word tuition, people feel it is the fees of coaching classes. Answer is coaching classes fees is not eligible for deduction. In fact, there could be a time in next 1 or 2 years, you may not even find coaching classes. Why? That is a different story. Point is, tuition fees does not cover coaching class fees. It covers fees that you have paid to university, college, school. or other education institution within India which is providing you full-time education. Like you join school, you are paying fees in school. You join some college, you join some university, you are paying fees over there, and it is for full-time education. Then take the fee receipt. Now you all may be going to college, you all may have taken admission in college. Check your college fee receipt, or even if you preserved your school fees, just see the receipt. In the receipt, you have many heads, out of which the very first head is tuition fees, and then you have the building fund, you have the ground fees, you have some uh, I-card fees, you have some other form fee, so many other fees are there. Now you will check, or you will find that the total of your fees comes to rupees 60,000, the total of this. However, out of this tuition fees is 38,000. So what is covered over here is in the total fee of your school or college, only the tuition fee amount, and the remaining building fund, sports fund, library fees, etc., has to be ignored. So in my example, even though my total fee receipt is of 60,000, I will consider only 38,000, which is tuition fees. And this I can get deduction for maximum of 2 children. Next, I have taken housing loan. Now, when I'm repaying this housing loan every year in the form of monthly installments, my monthly installments are made up of two components: interest, principal. Interest, I get deduction under HP head. Capital, principal, I get deduction over here. So what it says, any payment made towards the cost of purchase. Why I'm using the word principal? Because whenever I'm paying installment, it covers principal and interest. Interest is not covered over here because what is covered is only the payment towards the cost of either purchase or construction of a new house, new residential house. So wherever I have paid any amount towards the cost, and that is what is reflected in my principal component. Interest component is not the cost component. Principal component is the cost component. So whatever I have paid towards the principal component, which is reflected in cost, that is what is covered over here. So whenever you are paying housing loan installment every month, every year, out of that bifurcated into interest and principal. Interest, you take to HP, apply the limits, etc. over there. Principal component, you bring it over here and put it in ATC. And when you make a total of ATC, including this outer column, what you take is maximum 1,50,000. Huh. Technically, but it is only the construction cost, Hardik. It will not include the furnishing cost. Fine. Okay. So these are some major payments covered over here. Then you can see subscription to mutual funds, investment in 5-year deposit. This is your FD, which is of minimum 5 years, and it has to be with a scheduled bank. So if you have taken a FD, even doing an FD is eligible for deduction, provided it is of minimum 5 years and it is with a scheduled bank. Similarly, you have purchased bonds of NABARD. Again, you have done FD, but now here the FD is not with bank, it is with post office. So you have taken out time deposit, that is fixed deposit, again of minimum 5 years, and it is with the post office. So see, these are some of the payments which are eligible under ATC. Then they have given some conditions, some restrictions on its withdrawal. I request you all to read that on your own, right? इनएडमिसिबल पेमेंट मींस बेटा कि आपको उसमें पेमेंट की हुई हर चीज का डिडक्शन नहीं मिलता. जैसे लोन आपने निकाला है, लोन निकालते वक्त यू पे प्रोसेसिंग फीस, तो द प्रोसेसिंग फी इज द इनएडमिसिबल पेमेंट, राइट? Abhishek beta, construction purchase both are covered. That is specifically mentioned in the section. It is cost of purchase or construction. Fine. Okay. Students will just have a 5-7 minutes break. I'll just do some refreshment. We will start sharp by 4:15, 4:16, right? So that we cover more payments. Till then, you all can read the conditions that I have just skipped relating to withdrawal from these payments. Fine. Okay, let us continue. Now, the next few payments are applicable only to individuals because actually the schemes or whatever payments we are going to study are also designed for individuals only. They cannot be for family. Directly, the family payment will be now 80D. But before that, what are these individual payments? You have this 80CCC and you have the next section CCD. Now, what are both these sections dealing with? Have you heard about retirement plans? If you watch advertisements, generally all these insurance companies, they market retirement plans, right? Now, what are retirement plans? I remember the ad of a very famous ad, which says, "Na sar jhuka hai kabhi, na sar jhukega kabhi." This is the theme song where they show that an aged person is taking money from children, and the person is feeling very disrespectful because he has to take money from his children. And then the ad shows that he goes to flashback. He's young again. He's signing the policy of that particular insurance company. Again, he comes in the present. He's old. But now, since he had signed the policy and he had taken that plan, now he's giving away gift to his children and children's children. And now he's feeling proud. And then in the background, the music plays, "Na sar jhuka hai kabhi, na sar jhukega kabhi." Right? It is not Policy Bazaar. Policy Bazaar is not that ad. It is ICICI's uh, retirement plans. See, I'll show you. ICICI retirement plan advertisement. YouTube. Where are those ad gone? I think no, they are very old ads. No problem, but I don't think that should be a problem. I hope you all can see the ad, but this is not the ad I'm talking about. Okay, fine. Uh, it is not the ad which I wanted to show, but fine. So you can search for that ad. It is "Nasar Jhuka Hai Kabhi, Nasar Jhukega Kabhi." Now I am purposefully referring to that ad. That is what is my logic of the section number. It is ICICI retirement plan ad, and retirement plans are also called as pension plans. And the section number is also ICICI only. You have to just remove the I. That becomes the section number 80CCC. This is how you can remember the section number. So it is pension plan of private insurance companies, which includes LIC, which includes all other insurance companies. Right. Similarly, you have 80CCD. It is again the pension plan, but here it is the pension plan of government. And 80CCD is one of the most important sections. Sai, but I do not know the English translation of this because the ad was in Hindi, so I use Hindi. Unfortunately, I could not find the ad in English, so I just use the Hindi jingle which was playing in that ad. Okay, anyways, that is anyways not relevant. What I'm trying to tell you is 80CCC, 80CCD both deals with the same thing. It deals with the pension plan of ATCCC is of private insurance companies, which includes LIC, ICICI, Bajaj, everyone. And ATCCD includes the not mutual fund, sorry, pension plan of the government. Now, if you are making contribution to these schemes, you are eligible for deduction. Here, the schemes or the plans are applicable to individuals only. So there is no question that I may make payment for my spouse or my children. So that question will not come here. It is only in my name. Also, most important in ATCCD, we'll come to ATCCD in detail, because for ATCCD, you have many subparts. But before that, what I was trying to tell you is ATCCC and ATCCD both are same. The only difference is in ATCCC, the pension plan is of insurance companies. I'm using the word private, which includes LIC and other insurers. And in case of ATCCD, the pension plan is of central government. Now understand this. The point is that both sections give deduction for same type of plans, that is pension plan or retirement plans. However, there is some difference. Now, what is the difference? ATCCC is where only you are contributing to the plan and you get deduction for your contribution. Again, the limit prescribed is 1,50,000. But when you come to ATCCD, what is this ATCCD plan? As you can see the date over here, let me give you some history. In this year, 2004, the government took a very bold decision whereby it said that we will stop giving pensions out of our pockets. Which government has decided? Central government. It says that we will stop giving pension out of our pockets. What we will do instead is we will open a fund where while you are working with me, you also contribute, I also contribute. So something similar to Provident Fund. We open a fund which is over here called as the pension fund. So you are also contributing as employee, I'm also contributing as employer. And every month we contribute some amount in this. This becomes a fund. And then on retirement, you will get pension out of this fund. This is what is this ATCCD. It is also called as NPS, National Pension Scheme. It is also called as Atal Pension Yojana. These are the parallel names. Now, in 2004, it started only for the government employees. Later on, it was extended to even private employees, whereby the employers of private employees could also join the scheme, whereby they may open the pension fund for their employees. And same like government, employer is also contributing, employees also contributing, their money is becoming a fund and they will get pension from that. And then the third step was, now this scheme is open even to people like me, self-employed, where if I want to plan for my pension, now see, since I'm not working for anyone, there is nobody who's going to give me pension. So what I can do is, I can also join this scheme whereby till the time I'm earning, I will contribute in the form of my premium and I will decide an age. Now, since I'm self-employed, I'm not taking retirement from anyone because I'm not working for anyone. So I can decide an age. And after that age, I will start receiving pension from this fund. So now the scheme covers government employees, it can cover private employees, and it also covers self-employed. Now, what does the scheme says? Every month we contribute. We means employee plus employer. And it gets accumulated in your name as a fund. And after you retire, you can withdraw pension from this fund. This is what is this whole scheme. Now, before I proceed further with ATCCD, because I believe the only complication that you will find is somewhere in this 80 CCD. So before I proceed with this, let me inform you one more important section, which is 80 CCE. So we saw 80 CCC, we are reading 80 CCD, but before I go further in 80 CCD, I'm informing you the next section, 80 CCE. Now, what is so special about 80 CCE? Why I have come to 80 CCE in between? Because we saw 80C has a limit of 150. 80 CCC, this section also has an independent limit of 150. And below the section which we are studying, 80 CCD, it is also having an independent limit of 150. However, pay attention. 80 CCE says that the combined limit of these three sections, I repeat, 80 CCE says that the combined limit of these three sections is also 150. So individually 80C is 150, individually 80 CCC is 150, individually 80 CCD1 is also 150. But even if you combine these three sections, total limit of these three sections combined is also 150. I hope this is understood before I proceed. Any questions with this? Kameshwari, but I gave you example. You are investing in all the items in 80 CCC. You are investing in 80 CC. Sorry, you are investing in different items of 80C. You are investing in 80 CCC, that is the pension plan of ICICI. And you are also investing in pension plan of central government, that is 80 CCD. Point is, the collective limit of these three combined is also 1,50,000. What I mean to say, independently 80C said 150, this also said 150, this also said 150. But the point is, don't look at these individually, see this combined. So if you are making investment falling in 80C also, CCC also, CCD1 also, the combined limit of all these three is also 1.5 lakhs. Nayan, I'm coming to that point. Let me take you step by step. Sai beta, just give me some time to answer your question because I'm discussing something else. Yes, Abhishek. It means I'm repeating the words of Abhishek. Total deduction of these three sections combined is 150. Like how till now we were discussing all the 23 items falling in 80C, make a total of that and then comparing it with 150. Now I'm saying make a total of all those 23 items plus 80 CCC payment plus 80 CCD1 payment. So make a total of these 25 items and the total limit of all these 25 items combined is 150. Yes, perfect, Ambeshwari. Okay, everybody understood? Now let me just answer Sai's question. He has put it twice or thrice. Sir, is investment in private pension funds covered in 80 CCD? The answer is no. Lahiri is asking, sir, if an assessee invests in two of these sections. Okay, if you are investing in two of these sections, limit is 150. Rashmi, I'll answer your question a bit later. We are right now at the stage of depositing. We'll come to the stage of withdrawal later. Let me not mix two things again. So pay attention. So now we have understood that the combined limit of these three sections is also 150. Now, pay attention. 80 CCD is having three limits. I repeat, 80 CCD is having three limits. 80 CCD1, 80 CCD1A, and 80 CCD2. So, 80 CCD is divided into three parts. 80 CCD1, 1A, 2. Now, what is the difference? In the entire Income Tax Act, 80 CCD is such a section which is giving you deduction for your own contribution, which other sections are also giving, but it is also giving you deduction for contribution by your employer. Now, this is not allowed in case of provident fund. This is not allowed in case of superannuation fund. This is not allowed for any other fund where you are also contributing, your employer is also contributing, you get deduction only for your contribution. However, this section 80CCD, and then we'll have the other section 80CCH. These are the only two sections in the entire Income Tax Act which says that for your contribution, you are getting deduction, but even you will get deduction for the contribution of your employer. And that is what is covered in 80CCD subsection 2. So we have subsection 1, we have subsection 1A, we have subsection 2. For the time being, I keep 1A aside. So you have 80CCD 1, you have 80CCD 2. 1A will come a bit later. Now, this limit of 150, combined limit of 150 is covering only 80CCD 1, that is, it is covering your contribution. Whatever contribution I am making on your behalf, you are eligible to get deduction even for my contribution, and my contribution, that is employer's contribution, is not falling in the limit of 1,50,000 for employer's contribution. There is no amount limit. Employer's contribution is falling under 80CCD bracket 2, and for employer's contribution, there is no limit of amount. There is only limit of percentage. What is the percentage limit? If your employer is central government, state government, up to 14% of salary, up to this amount, if the employer is contributing, whatever employer is contributing up to 14% of salary, that is eligible for deduction under 80CCD 2. So you have this limit of 150 separate, and this employer's contribution to your fund is allowed in addition to this 150 limit. So you are having this 150 limit, which is combined with other two sections also. So you have 80C, 80CCC, and you have 80CCD1. So these three sections combined is 150, 80C, 80CCC, and 80CCD1. These three sections combined limit is 150. Besides that, you have one more 80CCD, you have one more 80CCD. What is this 80CCD? This is your employer's contribution. So you are getting this 1,50,000 limit for these three sections combined, which we just discussed. Besides that, you have two more deductions, and these are allowed in 80CCD only. Out of these two, I am for the time being referring to this, that is the deduction for employer's contribution. This employer's contribution deduction is allowed to you under 80CCD bracket 2, and the limit is 14% of salary if your employer is a central or state government. Correct? Now, what if your employer is a private employer? If your employer is a private employer, that is other than central and state government, then the deduction is limited up to 10% of salary. However, this section is the section which is allowing you deduction even under the new scheme. So where your employer is contributing in 80CCD, this deduction is allowing or allowed even under the new scheme. And when you are taking deduction of employer's contribution under new scheme, the limit for employer's contribution is 14% of salary. So if you are working with a private employer and you are following old scheme, the limit is 10% of salary for employer's contribution. But if you are following the new scheme, then the limit is 14% of salary for employer's contribution. I hope this is clear. So we are talking about 80CCD. 80CCD is the pension plan of central government, which is also called as NPS, National Pension Scheme, which is also called as Atal Pension Yojana. In this, whatever you are contributing, which is covered under 80CCD bracket 1, that is subsection 1, that is eligible for deduction. But this is having a limit of 150, which is combined with the previous two sections. So these three sections combined, the limit is 150. Then comes 80CCD bracket 2. That is for my contribution that I'm making to your pension fund account, where the limit is up to 14% of salary and up to 10% of salary, depending upon who is your employer and which scheme you are opting for. I hope this is clear. Yes, Lahari. Hardik, I'm answering that. I've intentionally kept that aside. Let me just go slow with this. Let me first cover what I want to cover, then I'll answer your question. Okay. Now, I'm still saying we have spoken only about two things: your contribution, my contribution. My contribution, that is employer's contribution, how much deduction you get, there is no amount limit. It has nothing to do with this 150. You can get this deduction up to 14% of salary if I'm central or state government. If I am a private employer, this will be 14% again if you are following new scheme. But if you are following old scheme, this will be only 10%. So effectively, what Lahiri said, I will put it in her words. If you are following new scheme, irrespective of who is your employer, whether your employer is central government, state government, or private, for you, this deduction, that is 80CCD2, that is for employer's contribution, it will be 14% of salary. If you are in the old scheme, now, if your employer is central government, state government, you get 14% again. But if your employer is a private employer, you get up to 10% of salary. This is the limit of deduction for employer's contribution to this particular fund. Is this fine? Clear? Now, this point is left. This point is giving you deduction of extra 50,000. Now you'll say, sir, now what is this point giving you deduction for? This point is giving you deduction for your own contribution. Your own contribution is covered here, yes, but this point is having an overall limit of 150 along with the previous two sections. So 80C, 80CCC and 80CCD bracket 1, which is your contribution, the limit is 150. But you have made contribution of 2.5 lakhs. Now, when you are making some contribution to this pension plan, there is a percentage limit also on your contribution. What is the percentage limit on your contribution? See, the percentage limit on your contribution is 10% of your salary. This is irrespective of which employer you are under, which scheme you are under. The percentage limit for your contribution is 10%. Now, how much you have contributed? You have contributed 2.5 lakhs in this pension plan. How much is this 10% of salary coming to? The 10% of salary is coming to 2,20,000. So first we have contributed 2.5 lakhs. Out of that, 2.20 is only eligible for deduction because the limit given for your own contribution is 220. So 2.5 lakhs you contributed, limit of 10% of salary makes it 2.2. you take 2.2. Now you start applying the deductions. You have 80C, you have 80CCC, and you have 80CCD, your contribution. How much is your contribution eligible amount? 2.2 lakhs. Now, let us say 80C was 50,000. CCC is 0. So let us keep this aside. And here your contribution is 2.5 lakhs, out of which 2.2 lakhs is eligible because of this 10%. So 50,000 is 80C, 2.2 lakhs eligible is 80 CCD, total is 2.7. You cannot take 2.7 here, you can maximum take 150. 150 means you have taken 50,000 of this, and out of this 120 you have taken 1 lakh. So this is how your 150 limit is satisfied. You take the deduction of 150, but here you are eligible for 2.2 lakhs. After applying this 10% limit, you are eligible for 2.2 lakhs. Out of 2.2 lakhs, how much you have claimed here? In this 150, 50 was 80C. So you have claimed 1 lakh out of this 2.2 lakhs. So your 1 lakh is only utilized. Still 1.2 lakhs is left. Now this you were losing till date. However, they later on introduced another subsection 1A. It said that if you are not able to claim full deduction in subsection 1 for your contribution because of the limit of 150, we will give you extra limit of 50,000. So subsection 1A gives you extra limit of 50,000. So now effectively your total limit becomes 80C, 80CCC, 80CCD. These three combined 150 for your contribution, and then extra 50 for your contribution in 80CCD bracket 1A. So effectively your total limit becomes 2 lakhs. 150 for these three sections combined, and extra 50,000 for your contribution if you are not able to get the full deduction. And besides this, the third deduction which we already discussed is employer's contribution, which is allowed without any amount limit. It is only having a percentage limit. So this is how this total deduction is. So 80C, 80CCC, 80CCD bracket 1. All this is your contribution, total 150. Now you have more contribution of 80CCD, out of which only some part is utilized here. So balance you can utilize here in the form of extra 50,000. So effectively both these limits combined, you have effectively 2 lakhs limit. And then whatever is my contribution to your CCD, that is pension scheme, for this my contribution, check that 14% criteria. Whatever amount is fitting in 14%, that amount is fully allowed as deduction for my contribution, because for this there is no amount limit. But it is 1A. I hope this is clear. Achha, talking about that additional 50,000. Where is this additional 50,000 covered? Bhavana, beta, additional 50,000. Yes, sir. Beta, we will cover the numericals. We'll cover the numericals, but for covering the numericals, Nitish, we first need to have basics clear for the provisions. And I cannot mix both things together, because if I start taking numericals in between, it may be difficult for us to understand, right? Okay. Yes, it is 1B is for additional 50,000, Hardik. So 1B gives you the additional limit of 50,000. So 80 CCD bracket 1 is the overall limit of 1,50,000 plus extra 50,000 is allowed as per 80 CCD 1B. This total makes your limit up to rupees 2 lakhs. And then you have 80 CCD bracket 2. This 80 CCD bracket 2 gives you deduction for the employer's contribution, for which there is no amount limit. There is only percentage limit applicable. Yes, beta, Nitish, I understand there will be some confusion because we are mixing different sections, we are mixing different limits. So do one thing. Or okay, let us do one thing. See, anyways, today I have not kept anything for practical. So for the timing today, let it go. Let us not do lot of khichdi today. Let us not do lot of khichdi today. Otherwise, too many things at the same time will go bouncer. Just remember or listen to what I'm saying. How to apply this practically, that anyways in the next lecture when I will be taking some practical examples after few sections are done, so that all sections practical would be easy. Yes, Lahiri, 1A is talking about old scheme and new scheme, correct? So the limit of 50,000 is given in 1B, and 1A is talking about if you're opting for old scheme or if you're opting for new scheme. That is what is 1A dealing with. Fine. Now, in this same section, the next question comes, what is salary? I think this was Hardik's question earlier. So salary over here means the same as you had in the salary chapter when you are computing the deduction for RPF. So for RPF, when you are computing the deduction, the salary was basic, DA forming part, percentage commission. The same salary has to be taken over here for the purpose of computing this 10% or 14%. Fine. Now, we come to the last part of this section. Bhavna is asking, sir, 80 CCD1A for old scheme. Yes, beta. Now, we come to the last part of this section. What is this last part? This again was somebody's question. I'm trying to find out in the chat. I'm not able to identify, but somebody had asked me this question, for which I said, I will cover your point later. So, what is this question? I think Rashmi had asked this question. Now, till now, we were discussing what will happen to the amount which we are contributing. So when we are contributing, when we are depositing every year, while the time I am in employment, I am getting deduction under this section. So as I'm depositing, I'm claiming deduction. As I'm depositing, I'm claiming deduction. Now, my job ends, and now it is the time to get the pension. What will happen when I get the pension? So for this point is there, deemed income. The amount standing to the credit of the assessee in the pension account, for which deduction has already been claimed by him under this section, and accretions to such account shall be taxed as income in the year in which such amount are received by the assessee or his nominee. So now when you are depositing, you are taking deduction, great. But when you will be receiving money from this account, I will tax you at that time. So now whatever you deposit, you take deduction. And when you are going to get back this money, whatever deduction was allowed to you, to that extent, when you're receiving the money, I will tax it. Now, when will you receive the money? One, closure of this account, or opting out of the scheme, you do not want to continue the scheme, or receipt of pension from the annuity plan purchase or taken on such closure or opting out. So this is one of the scenarios you will be getting the money. One is the closure of the account, one is closure of the scheme, and third is getting pension from the annuity plan purchase or taken on closure or opting out. Now, what is this? The amount received by the nominee on the death of the assessee under the circumstances referred to in A or B shall not be deemed to be income. This is equivalent to what we studied in 1010D for life insurance. If life insurance policy money is received at the time of death, it won't be taxable. Similarly, why your account is closed or why you have opted out of the scheme? Because the person has expired. In such a case, whatever amount lump sum he will be receiving, not he, his nominee will be receiving, that will be exempt. Further, the assessee shall be deemed not to have received any amount in the previous year if such amount is used for purchasing an annuity plan in the same previous year. So let us say you are closing this amount, you get lump sum 20 lakhs. You are not taking this 20 lakhs. You are putting this in annuity plan. That is, you are buying another insurance policy out of this 20 lakhs, which is a one-time annuity plan policy. So you pay that 20 lakhs one time. Now, when you receive this lump sum amount from the scheme and you have put it in this annuity plan, in this year again, nothing is taxable because you did not get anything. You remove the money from pension plan and put it in annuity plan. Now what will be taxable is what you get from the annuity plan, which is given over here. That is, you will be receiving the pension from the annuity plan. That is what is taxable. So if you have taken the money and put it in annuity plan, nothing is taxable for that lump sum amount. Now, what is the exemption for getting this lump sum amount? So now you have closed the account, you got the lump sum money of 20 lakhs, you are not putting it in annuity plan. If you would have put it in annuity plan, nothing would have been taxed in the current year. But now you are not putting it in the annuity plan, you are taking it along with you. Now what will happen? Then it says exemption on payment from MPS trust to an assessee on closure of his account or opting out of the scheme. As per 80 any payment from NPS to an assessee on account of closure or opting out of the scheme is taxable. So if you are taking this money and you are not depositing it in an annuity plan, then it will be taxable. If you take the money, deposit it in any plan, we studied about, nothing is taxable. Now, you have taken the money and you are not depositing it in annuity plan, it will be taxable. However, there is some exemption. What it says, 1012A provides that any payment from National Pension Trust to an assessee on account of closure or is opting out of the scheme referred to in this section, to the extent it does not exceed 60% of total amount payable to him at the time of closure or opting out, shall be exempt. So this lump sum amount of 20 lakhs which you took at the time of closure of the scheme, out of 20 lakhs, 60% means 12 lakhs will be exempt. So only 40 lakhs is taxable. But there is something else. Exemption on payment from NPS to an employee on partial withdrawal. Now what is this? Your scheme is not yet closed. You are still in the scheme. Your scheme is still going on. In between, you need money, so you do partial withdrawal. This exemption is for partial withdrawal. To provide relief to an employee, subscriber to NPS under 1012B provides that any payment from NPS to an employee, means you have not yet retired, your scheme is still going on, but you are withdrawing in between. Under the pension scheme referred to in this section on partial withdrawal made out of his account in accordance with the terms specified under the Pension Fund Regulatory Development Authority Act and the regulations made thereunder shall be exempt from tax to the extent it is not exceeding 25% of the amount of contribution made. So withdrawal in between the scheme up to 25% of your contribution made will be exempt. And at the end of the scheme, if you are withdrawing money, up to 60% of lump sum withdrawal is exempt. And if at the end of the scheme, you are withdrawing money and you are purchasing another annuity plan, nothing will be taxable. So this is how the withdrawal becomes taxable. Yes, Bhavana. So at the time of closure, if you withdraw the lump sum amount, 40% of the lump sum amount will be taxable and 60% would be exempt. And partial withdrawal, 25% would be exempt, 75% would be taxable. Yes, but 25% of what? 25% of the contribution made. So students, this is the entire 80CCD. So it has so many legs. First leg is the contribution leg. In contribution, you are contributing, your employer is contributing. Your contribution is having two parts of deduction. One, which is covered in 150 limit, common limit, one additional 50,000 limit. And together combined, they have to be within 10% of salary. Then comes employer's contribution. Employer's contribution do not have an amount limit. It simply has the limit of percentage, where the percentage limit for employer's contribution is 14% for central state government employees, and for private employees, it depends upon the scheme they are in. If the private employee is opting for the new scheme, it is 14%. If private employee is opting out of new scheme, that is going to the old scheme, it is 10%. And all these percentages are percentage of salary. Correct? So see here they have given the limit of deduction under these three sections, ATC, CCC and CCD1. CCD1 is your contribution. Together, individually, the limit was 150, but combined, the limit is also 150. Then you have additional deduction. Beyond this 150, you have further 50,000 limit, which is for your own contribution. It is over and above the limit of 150. And then for employer's contribution, it is 14%. There is no amount limit. It is only the percentage. It is 14% of salary where the employer is central or state government. And it will be 14% for private employer also if you are opting in new scheme. And it will be 10% for private employer if you are opting out of the new scheme. But a definition of salary is basic plus DA plus percentage commission. Yes, Bhavna. So that is what I'm talking about salary. Salary includes basic plus DA plus percentage commission. See, it is given here. For computation of limit of 80 CCD1, CCD2, salary includes DA if the terms of employment so provide. So this is what is DA forming part. And it includes all other allowances and perquisites, but we include percentage commission. 25% is what exempt or taxable. Tambeshwari, 25% is exempt. So whenever you are withdrawing in between the employment, so your employment is not over, you are still in job, but you need money. And till date, you have contributed 10 lakhs to the firm, to the fund. So till now, your contribution to the fund is 10 lakhs. So if you withdraw up to 2.5 lakhs, nothing will be taxable because it will be 25% of your contribution made till date. But let us say you withdraw 4 lakhs. Now, till date, in the fund, you have contributed 10 lakhs. You are withdrawing 4 lakhs. 4 lakhs comes to 40%. So we will allow you deduction only of 25%. 25% of your contribution till date was 10 lakhs. So 2.5 lakhs is exempt. You have withdrawn 4 lakhs. So 4 lakhs minus 2.5 lakhs, 1.5 lakhs would be taxable. Vinuta, ATCC, ACD both come under ATC. They don't come under ATCD, beta. They are separate sections. The limit for these three separate sections is combined 1,50,000, and this is what is given in ATCCE. So we cannot say it includes ATCCD. ATCCD is a separate section. Yes, beta, Apurva. Extra 50,000 is only for NPS. Tanya is asking, sir, if tax paid in 115 BSc, what is the percentage of central government is exempt? 14%, beta. Government, it is 14%. Fine. Do one thing. See, I understand this is not a simple section. There are so many variations in this. So today you can read this section again, read it minutely, so that when in the next lecture we go to further details, it will be easy. Nitish is saying, sir, if I withdraw 2.5 lakhs in 24-25 and 25-26, 1.4 lakhs, what will be exempt with limit of? No, beta, 25% is not your limit every year. It is the 25% is limit of your total contribution made. Now, till date, whatever is your total contribution, you have to take 25% of that. If you have withdrawn last year, that was within 25%, the entire amount was exempt. Again, you withdraw this year, so add both the amounts, compare it with 25%. So in other words, 25% limit is the limit which is allowed once. If last year you withdraw something which was below 25%, entire amount was exempt. Now you have withdrawn something else, like in your example, last year you withdraw 2.5, now you have withdrawn 1.4. So total withdrawal till date is 3.9. check how much is 25% of your contribution. Let us say 25% of your contribution comes to 3 lakhs. So out of 3.9, 3 lakhs is exempt, 0.9 will be taxable. Pallavi is saying in illustration 5. Yes, beta. It is 10 lakhs is your 1 lakh per month is your salary. DA is 40% of basic, 50% forms part. So you have to add this 1 lakh plus you have to take 40 ka 50%, which is 20. So it has to be 1,20,000. You are saying they have not taken 120. Please check if they have taken or not taken 120. See, they have taken, na beta. You are saying they have not taken DA. They have taken DA. They have to take DA. So your basic salary is 12 lakhs at the rate of 1 lakh per month. And then DA is 40% of basic, and out of that 50% is forming part. So you take 40% of basic and 50% of that amount. So it comes to 240. They have added. And on that basis, they have computed the limit of 10%, 14%. So they have done that, beta. You said they have not taken DA. Pallavi, please check. They have taken DA. They have to take DA. Right? Good. So students, don't worry. This is one of the most complex concept because there are multiple ifs and buts. So go back, read it patiently at your speed, see the example given there so that when we discuss, it will be easy. See, beta, percentage commission always comes, even if they have not written separately. I'll tell you why. Even when you go to the salary chapter, gratuity and all, over there also in the act, percentage commission is not written. But percentage commission is not written because they have, it is given in the act. Percentage commission is covered because it is always considered as part of basic salary. How? If you are a person like a salesman, your salary is calculated as a percentage of sales that you make. So that is your basic salary. That is why there was some case law of Honorable Supreme Court. In that case law, they have said that you should include percentage commission. That is why we include it is never given as part of the act. So even where in the earlier salary workings, wherever percentage commission we were including, that was not because of the act, because it is nowhere given in the act. Fine. Yes, you will take Bhavna DA only forming part, not the normal DA. Nitish, that will cover later. Exactly. That is what is the point. Because when you are covered in the Payment of Gratuity Act, you have a specific act regulating it. So you draw the definition from that act. When you are not covered in the act, it means there is no specific act, and that is where the Supreme Court decision is applicable. This is what I am also saying. So it is not written anywhere in any act. This is what I am saying. But it is coming because of the Supreme Court decision. But Supreme Court decision is not given with respect to Gratuity Act. See, Payment of Gratuity Act is a very specific act. So that decision has not come with respect to that act. That is why when you are computing as per Payment of Gratuity Act, you strictly take the provision over there. Over there, if you remember, we also do not take gratuity for, we do not take DA forming part, we take full DA. So even the Gratuity Act is not following the rule for DA, correct? I hope you remember that when you're doing working, the Gratuity Act, DA, what is taken is the full DA. It is not DA forming part. So Gratuity Act is a very special act. So all workings are strictly as per the Gratuity Act. You do not apply any other rule. But for other workings, you apply the general rule, and as per general rule, DA forming part will be taken, and as per general rule, percentage commission will also be taken. Fine. Excellent. So students, we stop over here. Please read whatever we have studied till this point, because that itself is too much for one day. But yes, do read it. It will take time to absorb, but it will absorb. Fine. So we catch up in our next session. We continue this and we proceed further. Fine. Sure. Thank you. Thank you very much. Thank you all. Yes, sir. We can close.